Let's bring in former Fed Vice Chairman and CNBC contributor Roger Ferguson for his reaction. So, Roger, good morning. You know, we knew going into yesterday's decision in the press conference that the Fed felt that policy was already somewhat restrictive. It was already restraining the economy. Inflation was below its expectation for this point in the year already, and that they would probably be looking toward a pivot. Yet the market seemed to be surprised at the clarity of Chair Powell's comments, sort of delinking the economic path next year from the likelihood of easing. What stood out to you?
I think three things stood out to me. First was, in fact, the market reaction. I think it was probably outsized compared to what anyone would have expected, with Powell saying things that were, pretty obvious. Second, I would say, that they themselves are clearly feeling much more comfortable. 3 weeks ago, Powell was saying it's too early to even talk about rate cuts, and here we are 3 weeks later, and he admitted that rate cut discussion was at the table. I think he said something in that phrase. And then third, the real expectation of 3 cuts being so clearly pointed out in the so-called dot plot. So it was, for me, a move that was a little more firm in the rate cut direction than I had personally expected.
And so where does that leave us? Clearly the market is going to test exactly how fast rate cuts might happen. Goldman Sachs is now saying it's pulling forward its expectation of when they start and how deep they go. And I think largely it's because each time Chair Powell was given the opportunity to say, well, if the economy holds up, maybe we won't get easier, or it's making it a little bit more of a higher threshold to start easing, he seemed to decline that. So do you think the markets have overshot this, or is it in a place where the Fed can live with?
Well, first we'll find out, right? Because, once they come out of the so-called blackout period, we'll start to hear from them, and we'll observe, are they attempting to more aggressively push back, which Powell did not do yesterday. So I think what's really interesting is now the entire dynamic is not whether or not there'll be cuts, it's how early. And I actually think it makes it maybe a little more challenging for the Fed. You've had some people talk about the fact that we still have fiscal stimulus running through the system. Obviously, with this rapid decline in interest rates, that's going to create some more forward momentum. So I think while rate cuts are very much on the table, I don't think it should be a foregone conclusion yet that it's got to be in the first part of the year, because I think there are some good signs of underlying strength. And remember, they want to try to execute a soft landing, get that inflation down to 2%. And I think he himself said that the last mile may still be a little tricky because there are the kinds of cross currents that we're talking about now.
Yeah, Roger, I don't know if you heard our earlier discussion. I think I was kind of taken with how human he sounded, just recognizing, and what he said didn't surprise me, but because he's the Fed chairman saying it, maybe that surprised me a little bit. It was more than I would have anticipated, because we expect Fed chairs to always be a little oblique, a little hidden in what they really think about things, but it sounded very human to me. It's just, the market will take and run with whatever phrase he said that they want to go with. He was, if you looked at the entirety of his comments, he said inflation's too high. He said all of those things, but he also said some things that anybody who wanted to think rate cuts are coming was able to really laser focus in on.
Well, I think that's right. First thing, Becky, those of us who are in central banking, there's been a trend towards transparency for quite a while.
Yeah.
Long ago were the days of mumbling with great incoherence. And so Chairman Powell is very much in that camp. Secondly, the so-called dot plots, the SEP as it's called, you can't really hide from that. Once the committee puts out that they are effectively expecting 3 rate cuts, that's sort of the central tendency, that's the median view. It's a little hard to nuance that when the conversation is already around how quickly rate cuts are. So, the final point, I think you are very correct. If you read everything that was said, there is still some tone in there that inflation is still too high. There's still some tone in there that we're not sure the job is done yet. I think he even said the phrase, if we have to raise, we will. But, to your point, the weight of the human nature seemed to be, we really are looking at cuts, which was, quite a move from 3 weeks ago when it was thought to be premature. So I guess now it's perfectly okay.
Yeah, I mean, look, the market can sort of acknowledge that we're not there on inflation, and in fact that the dot plot, as you mentioned, did have those cuts in there, but still doesn't even have inflation down to their target at the end of 2024, right? So it seems as if there's leeway in there. You mentioned clearly the Fed has hoped and wished and tried to plan for a soft landing. And I keep bringing up 1995 every time, not because it's a perfect model for what happened, but because one of the takeaways from that period, when Greenspan did follow up a tightening cycle by actually sort of pulling back and easing a few months later with a good economy, a decent economy, was this acknowledgement that unemployment could go lower than we previously thought without stoking more inflation. And I just wonder if there's an analogy here to say we have this structurally tight labor market. We don't necessarily need a lot more people out of work to do the job on inflation.
Look, I think Powell has been saying that all along. Early on, he said that the challenge is going to be to try to get the number of job openings down. So the JOLTS data, which is relatively new in all this process, was, I think, front and center. It was the number of job openings for an unemployed person that became one of the major metrics. And there are two ways to fix that. And, he was hoping for, and let's hope that it's worked, that the way they've managed to fix it is they're bringing down, openings gradually to be more in line with the number of unemployed individuals and bringing people in the workforce. So, that you can imagine, and he has said all along, though the path is narrow, there is a path towards getting inflation under control without really crunching the labor market. The other thing to recognize is some of this goes back to the old debate of permanent versus transitory. And, the team transitory perhaps thought it'd be months. In hindsight, it may well be that the healing of the supply side of the economy took not months, but years. And so you're getting, hopefully, a combination of the right amount of tightening, slowing the economy, and giving the chance for the supply side to heal itself and improve. And what's very unusual here is we've never had such a dramatic supply side shock. And that's the thing that perhaps takes, history and rewrites it, because this was a very unusual configuration.
Hey, Roger, we got to run, but very quickly, how come we look at the dots plots and say, hey, they're definitely cutting 3 times next year, when everybody was looking at the dot plot before and said, hey, they're idiots, they never get it right, the dot plot's always wrong? Now we believe
Look,
it?
the dot plot's not a fork. It is their current expectation. So I think what's interesting is that they're saying currently we expect. They'll do whatever data call for. But in the marketplace where it's all talking about cut, I think what's interesting about the dot plots is it is reinforcing where the market wants to go. And they didn't use words to try to push back too aggressively on that. We will see what happens once they come out of blackout to see if they are comfortable or they want to nuance it a bit more.